Hello and welcome to the day ahead. It's March the 23rd. I'm Nadine Blaney. Well, Wall Street gained back some lost ground as tech and growth stocks led the charge higher, investors buying the dip and banks benefiting from the prospect of higher interest rates in the United States. The MSCI World Equity Index, which tracks shares in 50 countries, was up approximately 1%. The conflict in Ukraine capped gains, weighing on sentiment as U.S. President Joe Biden warned that Russia is considering using chemical weapons. On Moscow's markets, the central bank saying the exchange to trade OFZ bonds will open again on Wednesday. However, the stock market remains closed. This as the Kremlin appears to have dodged a second default in as many days. With reports Russia has made an interest payment with the money allegedly processed by correspondent bank JP Chase. The U.S. exemption for interest payments expires on May the 25th, after which Russia will have $1 billion in payments to make. If missed, it could trigger the country's first default on international debt since the 1917 revolution. Now, it all comes ahead of a key virtual NATO summit expected to take place on Thursday, where the Ukrainian president will take part to discuss the war. However, exact details are still being worked out, and this comes after he addressed the Italian parliament through the overnight period. Now, bigger picture, traders are keeping a close watch on yield curves after the U.S. Fed Chair Jerome Powell's hawkish swoop rattled bond markets. While the difference between the 3 and 10 remains steep, the 2 and 10 curve, which is a key market gauge that signals recession, continues to flatten. Looking at the history books, the yield curve inversion lead time for a recession could be upwards of 2 years or as short as 5 months.
There may be a couple of months where they have to do the 50 basis points simply because they're not meeting the next month, and an intra-month hike would probably spook the market way too much. So, it was as hawkish as he's ever been, and the market really, I thought the market would have been down a lot more overnight with the yields flying like they did, especially the short-term 2-year yields, closing that gap on the 10 years and making that inverted yield curve ever more apparent or a risk moving forward. But the market seemed to take it in a stride. It looks like it's all factored in at the moment, and unless something comes out of the blue, I think we're okay for now.
Well, looking ahead, Goldman Sachs is forecasting 50 basis point rate hikes at both the May and June Fed meetings, following on from that hawkish speech from Jerome Powell. Futures are pricing in a 64% chance of a 50-point move at the May meeting. San Francisco Fed President Mary Daly joining her peers, calling for higher rates to combat spiking inflation. She says the main risk to the economy is too high inflation and that it's time to remove accommodation. Many in the market, though, believe the Fed is well behind the curve, and this rate hike cycle is purely based on inflation, which in turn is driven by things the central bank cannot control.
I'm a believer that they missed their window in May and June of trying to prevent a 7.98% rate of change on inflation year over year, which is what we have in the U.S. right now. While the economy was actually on the upswing, they would have had a chance to potentially slow it down and maybe cap inflation at around 4.5% or 5%. But now some of the things, not the least of which being caused by the conflict in Ukraine, are things that they can't really control, like crude oil prices, like supply chain issues. And again, like some of the supply chain issues we may get and supply issues we may get from the conflict with Russia and Ukraine.
On currencies, the greenback eased as the bump from Powell's comments earlier in the week faded, and rising equities helped boost risk-on sentiment. The yen, meantime, has continued its show of weakness after the Bank of Japan reiterated its stance on keeping its ultra-loose policy intact. The euro and sterling both higher, with the Aussie unit continuing to hold around that 74 US cent mark. Crypto was higher yet again. Bitcoin popped over 4% to flirt with 43,000 and kiss the 3-week high. Now it's currently sitting at 42,705. So, bringing it all back home, and the local market is set to open higher, with SPY futures up around 0.4%. Oil prices retreated marginally. Gold slipped to a one-week low on that hawkish tilt from the FOMC chair. Palladium dropped over 3%, with silver also nearing a one-week trough. Now, here in Australia, the focus is on KMD Brands. It's out with half-year numbers, reporting a net loss of 5.5 million Kiwi dollars on revenue down nearly 1%. The dividend, though, getting a 50% boost with an interim payout of 3 cents per share. Looking ahead, KMD remains confident, saying that it's entering the winter season well prepared with forward demand for Rip Curl products at record levels. Ex-dividends also in focus today with Myer, Briscoe Group, Seek, Virtus Health, and Fonterra all up for payouts. And that does it for the day ahead. For today, I'm Nadine Blaney. See you tomorrow.